You can resell your land, your house, your car, even you can resell your mobile phone. But can you able to resell your solar panels which is installed in one location? So this question set the floor for today's discussion about payback period. Welcome to Engineering Economy. I'm Dr. Nathan. Today's discussion about payback period. So why the payback period is really important in solar PV sector or solar power system. The first reason is that for the solar power industry, the capital cost of solar panel is very less. We will discuss that later. Then another common aspects that when we ask for the profit, the solar companies always tell about payback period because it is always difficult for us to calculate the profit because it is a 25 years investment, it's a 25 years project, and it depends on many factors. If you listen to the last video, we have listed 7 factors which can change over the years, which can influence the revenue generated in each year. I mean, which can influence the payback period as well. So let's go into the discussion, each slide by slides. Okay, first, before understanding the payback period, we have to understand why it is very important. So here the cost breakdown of the project. So now we are discussing about 50 kilowatts commercial scale project in location of Perth, Australia, which cost about 50,000 Australian dollars. So if you didn't listen last 2 videos, please go back and watch last 2 videos where we discuss about the how to calculate the kilowatt hour unit output per year and how to calculate the revenue per year and how to calculate the net present value, and today discussion about the payback period. Okay, so the cost breakdown, it is very important. Many people do not know. Only 25% of the cost come to the panels itself. And if you look at here, the 10% goes to inverters and 10% go to the mounting assembles and 55% go to installation cost and setup cost, commission cost, and the legal fees and the whatever the certification you had to obtain to keep the 50 kilowatts system at one location. So imagine this is a business. So this is not like buying a house. You can sell it after 1 year. Most likely you gain the capital gain. You receive capital gain in today's market trend. But even in the worst case, you lose at least maximum of 10% of money. So you are still in a safe side of the investment. If you're buying the car and selling after 1 or 2 years, you lose 10% of the car value, but you still are in a safer side. But if you compare those kind of investment with a solar PV investment, if you sell the entire system, what happen? Definitely you will lose this 65% of the money. Definitely, and clearly you lose 65% because installation cost, commissioning cost, all these service cost, and the mounting assembled cost all will be lost. Technically, you will get only the 35%. Even that 35% you will not get because solar panels, there's no second hand market, what we call second hand market or reselling market. There's no reselling market for the solar panels. Once it's installed in one location, it has to run for its lifetime. That is the current scenario. So many people do not explain this thing. So we are touching in that area. Because of this fact, we have to keep the solar panel running at least the time until we receive whatever we invest on the solar panels. Let's say for this example, $50,000 we invested. So until the point we receive $50,000, we have to make sure we are able to run the the solar panel, uh, the project. I mean you had to generate the electricity and you had to sell it to grid. So all these things, you had to own that land, or maybe land or the rooftop, whatever it is, you had to own that property. So these all are important, at least the bare minimum until the payback period is reached. So currently the payback period is in Australia, in all over the world, is 5 to 7 years. This means at least if you are committed to invest, you have to keep that the solar power project until 5 to 7 years. At least you reach that the break-even point. I mean, there's no profit or loss. You are safe with your investment. So that's why if you go and search about solar PV, always it come up with the payback period. When we talk about investment, solar PV, it is always the term, the magic term is payback period. So now we are not really, I always saying like we are going to use the payback period, that is a financial term, for our problem. Our problem is that my investment is not relocatable or resellable. So this is not like buying a house or buying a car. This is different. This is setting up the company. You are going to set up a company with $50,000. You cannot sell it immediately. You have to keep it at least 5 to 7 years. There are different schemes for selling the entire house. I'm not touching that area. So, I mean, you cannot remove the panel and hand over to someone else to use that solar panels, because there's technically or practically there's no such things available uh, in a profitable manner. Okay, so that payback period mean cost simple is a cost of investment divided by average annual cost flow. So if you know the cash flow every year, if it is cash flow is equal, less for this example, like you are investing $20,000 and every year you are earning $4,000, then your payback period will be 5 years. $20,000 divided by 4,000, it will be 5 years. So at the end of 5 years, you will receive entire investment you make. And a simple payback period will not consider the inflation, depreciation, maintenance cost, project lifespan, other things. So in simple term, a simple payback period do not consider the time value of money. In this case, the $4,000 you are receiving at the year of 50 year has very low value compared to the $4,000 you're receiving in the first year. So that in the last video we learned about net present value. You had to bring every future revenue to the present value. Then only it become a real money and you can analyze. And one more important thing, what we are talking, it is about the estimated revenue, because for solar PV system, we are going to run the system for 24 years. So whatever comes after 10 years, even 15 years, it's estimation. We are not exactly sure what is that, but theoretically what the revenue we are receiving, we are talking about a theoretical estimation. Okay, so we'll move to the next slide. So payback period tells us how quickly the project will pay itself back the investment made. So it's very simple. You're paying $50,000. You need at least $50,000 back to your hand. Then you're safe. You're safe. Whatever come after that is your profit. So the payback period, usually the power solar PV investment is 5 to 7 years. It's depend on different system. And one more thing, we are talking about the commercial scale solar PV system. We are not talking about the rooftop solar PV system which installed in your house, like 3 kilowatt, 5 kilowatt, which is essentially it's for your own usage, own electricity usage. The promoting the point is generate and use it. But what I am discussing for all the series of these videos, generate and sell it. Entire whatever you generate, you sell it to the grid. It's a commercial business type of 50 kilowatt solar PV system. So you will get back whatever the money you invest within 5 to 7 years. So whatever revenue you generate after 5 to 7 years become your profit, because after that your investment is already covered. Whatever it comes, your profit. Because we are not considering the maintenance cost, all other costs, because in solar PV system is the beauty of a very positive thing is the maintenance cost is very very minimal compared to other business or other investment. Solar PV investment maintenance cost is very very minimal. Okay, move to the next slide. So why the solar PV, the payback period is very important, because payback period tells the break-even point. So you can obtain the true value of solar panel once all your investment have been fully paid off. As I said, if you want to invest 50 kilowatts on 50 kilowatt solar panel, if it is land mounted, you need a land. You are committed to do that investment. So if you want to do that investment, you have to make sure at least bare minimum how many years I have to run this solar panel project to reach my uh, the break-even point. That means like whatever investment you make will come back in that year. So you need to know whether it is a 5 year or 6 year or 7 year or 7.5 years. That is the question for today's discussion. Why that question is important? Because this project I already said, it is not like buying a car and selling or buying a house and selling. This is a process. You're setting up the company and this is the process. So can you able to sell, again the same question, middle of the project lifespan? So it is not possible. I already explained that it is not possible. So simple payback period and pros and cons. So simple payback period means it's very simple to apply, but the problem is you cannot get the real value of money. So it is simple to apply because you need a total initial cost of investment and annual cash flow. You need only these two information. But the problem is you don't know the actual value of money. Now we are going to look at the payback period, simple payback period for our investment. So as you know, the investment we made is $50,000. $50,000 total investment for it's made for 50 kilowatt solar panel. So these $50,000 we need to get back from the revenue generated by solar panels. So please watch previous videos to understand how we calculate these values, the revenues each year. So first year we got 7,920 revenue. So that we are finding the cumulative cash flow. So each year, whatever second year, so we are adding these 2 years and become 15,000. We are adding these 3 years and it become 23,000. And we are adding all 4 years, it become 34,000. And likewise, when we add all 6 years of revenue, that become 46,913. It means if you add all 7 years, it becomes 54,000 more than the investment. So at the end of sixth year, we are getting 46,000. So we are now clear that in the beginning of the seventh year, we are going to get the payback period. So payback period will be 6 years, some month or some days, 6 years plus. Example is 6 years plus. So what this means, if you don't consider any depreciation of currency or the time value of money, then the payback period is 6 years. Sorry, 6 years. Yeah, 6 years, some months or some days. Okay, so let's go and find what is exactly how much is the payback period. So at the end of sixth year, we got 46,913. So what is the remaining investment? We need to collect it from the revenue, that is 50,000 minus 46,000. It's become 3,070. So 3070. So it will be collected in the beginning of seventh year. So seventh year we are going to get the revenue of 54,615. So now we are finding the proportion. What proportion this 3070? This is a small value. This small money, small excess money we had to collect. So that become 0.056. It's nearly equal to 0.5 years. 0.5 years mean it's become 0.05 into 365 days. It become about 20 days. It's about 20 days. So in the next year, at the beginning of the seventh year, you can collect within 20 days. It means 6 years plus 20 days. Your payback period is 6 years plus 20 days. So 6 years, 20 days. So what this means, if you truly trust your economy, then economy and you like some countries, the currency depreciation is very low, less than 1%. Less than 1%. The currency depreciation. I mean, discount rate is less than 1%. In those countries, they don't no need to worry about the discounted payback period. So they can trust on these 6 years, 20 days. But can we trust? It's a big question. So in my suggestion, you always need to consider the discounted payback period. So let's move on to the discounted payback period. So this is about discounted payback period. So please watch the previous video to find the present value. So discounted payback period means we are going to do from the present value. So this is the actual revenue generated in the first year, and we're using this factor 1 plus. So this comes from the present value equal to future value divided by 1 plus r to the power n. The r is a discount rate, that is 3.4 percentage in Australia, and n is the number of years. So if you receive the revenue after 2 years, it n become 2. If you receiving the revenue after 3 years, n become 3. So here n is 1 and r is 3.4 percentage, and here n is 2, r is the same, n is 3. So we consider the discount rate is same, flat discount rate. I mean, we consider discount rate is going to continue, the same discount rate of 3.4 percentage is going to continue for entire 25 years. It's an assumption. I mean, we are for the simplicity of calculation, but in reality it's different. Okay, so let's go to the calculation. So we find in the cumulative values. So again, the cumulative values, we are adding these two and become here. We are adding all these three, become here. We are adding all these four, become here. So at the end of seventh year, we are getting 48,000 something. Sorry, my image is hiding the entire value. We can see in the next slide. So see that before we found like end of sixth year, we got the big value here, end of seventh year. So about 1 year different. So we clearly see that 7 year plus some days become a payback period. So go to this slide. So end of seventh year, we got this value. So what is the remaining investment we had to get? 50,000 minus this one is becomes 1,700 something. So it's a very small value. Then what is the 8th year revenue? That is 54,220. So what is the proportion? 0.03. So 0.03 years, it become 11 days. So it means your payback period will be 7 years, 11 days. See that the previous simple payback period and discount payback period is totally different. Can you see the difference? And here we emphasize the importance of going with the discounted payback period. So now the first question, if you want to install a solar panel, you are approaching a company. The company is saying the payback period is 7 years or 6 years. Let's say 6 years. Then you had to ask the second question: is it a simple payback period or discounted payback period? Then you had to ask the third question, but that is how much discount rate you consider. Then they will say they consider 3.4 percentage because it's standard discount rate. And we will come to the next discussion. We go with the comparison, then we go to the next discussion. Okay, so here this is a simple payback period here and the discounted payback period here. See that difference? And I always recommend go with this because you know the real value of money by doing this. And the discussion is that what if this discount rate is changing? Like I'm considering 3.4 percentage. Next year it may become 4 percentage, and next year become 4.5 percentage. Next year become 5 percentage or 6 percentage. So if the discount rate is changing, I mean the value of the loan amount. I mean the what the bank is charged for the loan interest. That is the simply you can understand what is the discount rate, or simply the depreciation value, or simply you can understand how much value the currency is losing every year. So if that is the case, then this discounted payback period with a constant discount rate is wrong. You have to go with a different thing. So this is the summary of today's entire discussion. So if you go for a simple payback period, as I said, some countries they keep their discount rate very low, like Japan. Let's say if you want to invest a solar project in Japan, you don't need to worry about the discount rate much because they keep the interest rate very low. Japan or Switzerland, uh, the countries, some countries they keep the discount rate very low, 1 to 2 percentage. So you don't need to worry much about that. So if you go with a moderate discount rate country like a little stable like Australia, 3.4 percentage, Canada maybe 2 point something or 2 to 3 percentage Canada. So these countries, the discount rate are stable, so you can trust their discount rate for next 5 to 6 years. So it's fine. But if you go with any poor performing countries or the economically impacted countries, then the discount rate keep changing every year. Then you have to analyze a little deeper. So even the well-performing countries, discount rate may go increase. Even Australia, it can go to 4%, 5%, 6%. So the fourth question you had to ask the solar company, How you come up with this 3.4 percentage? And they have to back up, I mean back this answer with some research. I mean usually economists, those doing the PhD or some research on economic sectors, they may publish a paper that predicting how much discount rate next year, next to next year. I mean the predicting the interest rate and the discount rate for next 10 years. So with that different modeling simulations ideas, they can strongly argue that this interest rate will not go more than this much, or the discount rate will not go more than this value. So with that information you can trust, okay, if this is the maximum 3.4% is the maximum discount rate, then yes, my payback period is 7 years 11 days. So you're happy now that your payback period is 7 years 11 days. So whatever you generate after 7 years 11 days, it's become your profit. Okay, now if you go to the little unstable countries like Pakistan, Sri Lanka, and Zimbabwe, so those kind of countries, what happened, the discount rate keep on changing. There you have to do little more research on your own, that how much it can goes, like will it go to 8%, the discount rate will go to 15%, or even it can go to 26%. In Sri Lanka during the economic crisis it went around more than 22%, only for a certain period of time, less than 6 months. Okay, this is only for 6 months. So what I mean to say that this is a research area. If you want to invest money in developing countries, you can get more profit because the labor is cheap and a lot of benefit. There are a lot of benefit. You can get more profit, but you have to invest little bit of money on these kind of analysis, like how the discount rate increases, how the another important things, how the buying price and the tariff of solar PV electricity. In case in future, if the government reduce the tariff, the buying rate of solar PV electricity, then you this payback period will increase, because now for Australia case we are considering 10 cents per kilowatt hour energy. What happen if these 10 cents become 7 cents? What happen if these 10 cents become 6 cents? So what happen, this your payback period will increase. So you have to analyze two things. You have to analyze the tariff, predict the tariff, the buying rate for next at least next 5 years. You have to predict the discount rate. So this all comes to probabilistic study. So now the probability come to play. How much possibility, how much you have the chance to keep this discount rate for next 2 to 3 years, 3.4% for 2 to 3 years. And again, we have different models we can create. Then we come to the statistics. How much deviation can occur from this? So, so this kind of research is a little going deeper into. That's why we hire some consultant, and he will do a little bit of analysis and tell what are the risks involved, what are the benefit you can get. Definitely, if you keep the solar panel for 25 years without any external disturbances, definitely you will get like more than 200% of the profit. I mean, whatever you invest 50,000, you will get more than 100,000 when you uh, keep it. But the problem is that if you give up the project in the middle, you lose the money. So at least if you have to keep the solar panels until the payback period end. The payback period may be 6 years, 7 years, 8 years, 10 years. We don't know. If the discount rate increase, it become payback period become 10 years, 11 years. I mean, until 11 years, you're not enjoying the profit. You're just accumulating your the investment. So after the 10 years time only, you can get a profit. So these are like in simple term in by companies or by people, they say like 6 years is a payback period. What that means at 6 years, you have to go deeper and understand what this 6 years payback period means. What really means, what the calculation is hidden behind that 6 years. And is that calculation is true? What are the variables involved? Basically the discount rate involved and the selling price of electricity involved. These two are key values. If the selling price of electricity changes and if the discount rate changes, your payback period will change. So um, we come to the end of this discussion. Please subscribe this channel. When you subscribe this channel, I get little more motivation. I can prepare the slides and you can present more such topics. Again, once again, please subscribe this channel and we'll see you in next video. Thank you very much. Bye for now.